The income statement is the key document that tells you if a company is successful. In this video, we'll learn about the income statement and why it is so important. If you've ever wondered how a company actually makes money, this lesson is for you. The income statement is the primary lens through which we view a business's success. Hello everyone, Professor Matt here with the Fundamental Investing Institute. In our lessons so far, we covered the foundations of financial accounting and how everything ultimately leads to the financial statements. Now we're diving into the income statement. When you read an income statement, you're really asking one big question. Did the company make money? The income statement answers that question because it shows revenues, expenses, and profit. Profit is simply revenue minus expenses. Positive profit means the company earned money. A negative profit means it took a loss. Think of it as the performance report card. It doesn't just show the end result, it walks us through the journey of how we got there. Whether you're an investor or a manager, understanding this flow is critical to seeing if a business model is sustainable. Most items on the income statement come from day-to-day business activities, selling goods and the costs required to do so. But companies also report non-operating items. These are things like interest expense, taxes, or gains and losses on asset sales. These aren't part of normal operations, but they still affect profit. This distinction is vital. We want to know if the company is good at its core business, selling its products or services, or if the profit is just a one-time gain from selling a building. Distinguishing core operations from other items gives us a clearer picture of the future. The income statement is built from income and expense accounts, which reset to zero each period. Thus, the income statement shows activity only over a specific period. It has a start date and an end date. That's why companies report quarterly or annually. It's a video of a period, not a snapshot in time. Unlike the balance sheet, which is a snapshot, the income statement is a summary of activity. Once the period ends, we clear the books and start over at zero for the next year. This allows us to compare performance from one period to the next. There are four major components we'll explore in future lessons. For now, here's a quick overview. Revenue is sales. Cost of sales is direct production costs. Operating expenses are the ongoing costs of running the business, like rent. And non-operating items cover taxes, interest, and gains and losses. Each of these components tells a different part of the story. Revenue tells us about demand, cost of sales tells us about production efficiency, and operating expenses show us the overhead. Together they build the bridge from top-line sales to bottom-line profit. The income statement tracks value, not necessarily cash. Income increases equity, while expenses decrease it. The final result is net income, the famous bottom line. It shows the increase in equity created for the shareholders during that period. So in short, the income statement tells us how well a company performed during a specific period. It's the story of revenue, expenses, and ultimately profitability. It is the cornerstone of financial analysis. To learn more, visit fundamentalinvestinginstitute.com, and don't forget to like and subscribe for more lessons.